comes to meeting your regular expenses or short-term financial goals, wouldn't you agree that stability matters just as much as returns? Traditionally, many investors have leaned on bank fixed deposits or government-backed small savings schemes for the sense of security. But times are changing. Today, the investment world is evolving and digital platforms are promising to make fixed income investing easier and more accessible than ever before. So one such platform is GoldenPi, which offers a range of fixed income products online. But here's the real question. Is convenience the same as reliability? And can these platforms truly replace the tried and tested options? So let's take a closer look on that. So hi there, welcome back to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So what are bonds? A bond is simply a loan you give to a borrower. It could be the government, a company, or even a bank, and they promise to return your money with interest. But before you jump in, you need to ask, what if they default? What if interest rates change? And what if I need my money back before maturity? Government bonds are the safest, but they often can't beat inflation. Corporate bonds can offer higher returns, but the trade-off is higher risk. That's where credit ratings come in. Agencies like CRISIL, CARE, and ICRA rate issuers from AAA, which is the safest, down to D, which is defaulter. But here's the truth. Ratings are helpful, not bulletproof. Remember ILNFS, DHFL, Yes Bank 81 bonds? They were all rated before things went south. So another key detail, the type of bond. A senior secured bond gives you first claim on collateral if the issuer fails. Unsecured or subordinated bonds your way down the payment queue, and perpetual bonds, they may never mature at all. So even if a bond is listed on a SEBI registered platform, safety depends on the bond itself, not the website. So there's credit risk, liquidity risk, and the temptation of flashy high yield offers that may hide higher risk. So knowing all this, how do online platforms like GoldenPi actually fit into the picture? They don't remove the risk, they simply make bond buying more accessible. So the real safety still depends on what you buy, not where you buy it. So with that in mind, let's take a closer look at GoldenPi, how it works, the type of bonds it lists, and the things you should check before deciding whether any bond on it is right for you. So GoldenPi is like the Amazon of bonds. From corporate bonds to fixed deposits, you can invest without leaving your couch. They are a SEBI registered debt broker and an online bond platform provider. So yes, they operate under a regulatory framework aimed at protecting investors. But regulated doesn't mean risk-free. So will the platform flag all risky bonds? Not necessarily. Are the search filters enough to pick the safest option? Only if you know what you're looking for. Regulation lowers fraud risk, but it doesn't remove credit risk. Your due diligence is still non-negotiable. So what are the product offerings on GoldenPi platform? So first, listed corporate bonds. They are issued by big corporations or government-backed entities. So some are secured, others aren't. They are tradable, but don't assume tradable means you will find a buyer at the right price right when you need it. So next, debentures. Often unsecured, higher risk. If you invest here, you are betting on the company's future cash flows. And next is NCD IPOs, non-convertible debenture public issues, fixed returns, so predictable payouts. But remember, predictable only if the company stays financially stable. Next, fixed deposits, FDs from banks and NBFCs like Bajaj Finance or Mahindra Finance. So familiar but still worth comparing rates, lock-in periods, and safety ratings. And sovereign gold bonds, SGBs. They are RBI issued government-backed 2.5% annual interest plus gold price appreciation. So great safety, but gold prices can swing. So sixth, government securities, G-Secs. So backed by the government of India, zero credit risk, perfect for capital preservation unless inflation eats into your returns. So bonds often pay interest monthly, quarterly, or semi-annually. That's steady income, yes, but are you losing out on compounding by not reinvesting? Will you reinvest each payout manually? Could equity or growth assets give you higher post-tax returns? Because for retirees, great. For long-term wealth builders, only if you have a disciplined reinvestment plan. So GoldenPi lets you start with just 10,000 rupees. Sounds amazing, right? But easy entry can mean hasty decisions. Ask yourself, how much of your portfolio belongs in bonds? Should this be your emergency fund? Probably not. Liquidity isn't always instant. So, does it fit your asset allocation and goals? Because sometimes the real risk isn't in the bond, it's in investing without a plan. So, now let's take a look at the platform features. So, GoldenPi's user friendly filters, quick KYC process, and even referral rewards can make it tempting to invest in just a few clicks. But here's the question. Are you investing because you have done your research or because the platform made it easy? Convenience is fantastic. Blind trust, not so much. Remember, investment platforms are designed to get you to transact. So your job is to go beyond the filters, dig into the issuer's financials, and understand the risk before you commit a single rupee. So now is GoldenPi right for you? So who is this platform really for? It works for investors comfortable with higher risk debt instruments, but only after you have built your emergency fund and secured your core investments like equity mutual funds. Think of it as a return enhancer, not the foundation of your portfolio. The core of your long-term wealth should still be diversified, liquid, and professionally managed. Qualities equity mutual funds excel at providing. So now let's take a look at the taxation aspect. High returns often come with hidden cost, and in bonds, taxes are one of them. Interest income from bonds taxed at your slab rate. Capital gains taxed differently depending on whether they have listed or unlisted and whether they are short term or long term. So before chasing that extra 2 to 3% yield, ask yourself, will it even beat inflation after taxes? And bond platforms love saying better than FDs, safer than equity, but here's the reality. Yes, equity funds can be volatile, but they rarely default. Markets tend to recover over time. Bonds, on the other hand, can deliver a permanent loss if the issuer defaults. So we have seen it happen. DHFL, ILNFS, S-Bank 81 bonds, investors lost crores. Even senior secured bonds can fail if collateral values drop or recovery drags on for years. So equity mutual funds, especially large cap or hybrid ones, offer diversification, liquidity, and SEBI regulated fund management, giving them resilience in the long run. So remember April 2020? Franklin Templeton shut down 6 debt funds overnight, freezing 25,000 crores. And these weren't failing funds. They had great past performance, but when the market froze, their illiquid debt holdings couldn't be sold. So if this could happen under a reputed AMC with SEBI oversight, imagine the risk when you're lending directly to lesser known companies through a bond platform. So TrueCap Finance once promised over 13% returns backed by small business and gold loans. Sounds irresistible, right? But when defaults rose, credit ratings dropped and liquidity dried up, the illusion shattered. By July 2025, TrueCap defaulted. So high returns, high risk. And credit risk is like an earthquake. Unpredictable but devastating. Smart investors don't just ask what's the return. They ask, can this survive a crisis? And often a well-diversified mutual fund portfolio managed by experienced professionals is far better equipped to handle those shocks. So here's the first thing you must understand. SEBI registration simply means the platform is a compliant intermediary. It does not mean your investment is risk-free. The actual risk lies with the issuer of the bond, not the platform selling it. So while the interface might look modern, the reality is your money is still tied to the credit worthiness of the company borrowing it. So the big risk nobody talks about is first credit risk. Many of the high yield bonds listed online are lower rated. The higher the promised return, the higher the risk of default or delayed payments. Are you being compensated enough for that risk? Number two, liquidity risk. Some bonds are illiquid, meaning if you want to sell before maturity, you may not find a buyer. That's a risk mutual fund investors don't face because funds handle liquidity for you. And third, misleading yield focus. Platforms often highlight just the attractive interest rate, but do they equally highlight the possibility of loss? Not always. And here's the reality check. ILNFS, DHFL, Yes Bank, 81 Bonds, SREI Infra, Reliance Home Finance, all of them were rated and traded before they defaulted. Past ratings didn't save investors then and they won't now. So, what is the final takeaway then? Let's be clear. Online bond platforms are great enablers. They make bond investing more accessible to retail investors, but they are not risk mitigators. So, if you are new to debt investing, start with low risk instruments. Be realistic about returns. Remember, safety lies in what you buy, not where you buy it from. So, here's where working with a certified financial planner can change the game for you because a CFP can build a smarter debt allocation using credit risk mutual funds instead of random unregulated bonds and balance return potential with real world liquidity and safety and align your debt portfolio with your actual life goals, not just marketing promises. Because let's face it, your peace of mind is worth more than a few extra percentage points. So if you found this video helpful, make sure to like, share and subscribe so you don't miss future insights that protect and grow your wealth. And if you want a free one-on-one consultation with a certified financial planner to build a safer, smarter investment plan, click the link in the description below.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.